G'day and welcome to the Investor Motivation Podcast. New background, but same Amy. Hey, Amy Lehmann, how are you?
Good, how are you?
Yeah, very well, thank you. Now, this is really ad hoc conversation. We're going to be talking a bit about cash. We're going to be talking about what makes a good investment and also what can make a great business still be a bad investment. Right now, we see share markets at all-time highs, and we're watching Warren Buffett accumulate cash beyond anyone's wildest imaginations, $350 billion. Why would he be doing this?
Well, yeah, as we know, stock markets have run really, really hard for the past, 3 years now, 5 years now since COVID. It just seems to be an upwards trajectory.
Yep.
And the percentages year on year are much higher than they are on average. So, yeah, I guess Mr. Buffett is expecting a correction in the market to bring us back in line with that average, which, a downturn or a correction in the market does present opportunity, and having that cash reserves ready to pounce on those opportunities when they pop up is what I would imagine he's trying to do.
Yeah, being a patient investor. And this is where, for a lot of people to say, hey, you were accumulating cash or selling out too early and you've missed out. But as always, share markets will go up with the escalator and down in the lift, which for those that are watching this, it's that. But then when it goes down really sharply because people are panicking. And what I've been telling clients, where we have been, I suppose, a little bit cautious and not wanting just to, pile in, large bulks of their money at an all-time high, that what we are achieving with their cash at the moment is around 4%, and that is your risk-free rate of return. I also state that really cash is not an investment strategy over the long term. Not for the long term, that inflation is a very real risk that you will not notice in the short term, but it will be devastating over the long term.
Yep.
And I think you mentioned about long-term averages, and let's just agree, and obviously the Aussie market in the last 10 years has not done 10%. Over a longer time frame, it's probably done better. The S&P 500 NASDAQ has done substantially better. But let's say the average is 10% or the median is 10%. That means it spends half its time above 10% and half its time below.
Yeah.
And that can be plus 30 and then minus 20 at other times. And this is where the Warren Buffett, I suppose, his experience and his mentality and his patience, the psychological side of it, is just off the charts in terms of patience. Because I know when people, there's a transaction in their world and they come into money, before the transaction's completed, they say, right, what do I do? Quickly, I need to do something.
Yeah.
And
pre-allocated some of it already, and they want to ride that really great bandwagon that has been the performance that we've seen in recent times.
Yep.
But that understanding and looking at graphs and seeing that volatility all the time, and it's not always going to be up for forever.
Yeah.
Well, at the rates that it is anyway.
That's right. Yeah. And so I think there's time for patience, because share markets do, they do bounce in between, obviously highs and lows, fear and greed. And when markets are going particularly well, that's where people are more buoyant and they see recent past results and the biases kick in to say, let's go again.
Yeah, absolutely. If everyone is looking at that surface level, which, most consumers are that aren't, really into the markets like we are, it's not their job, it's not their hobby. Even seeing those short-term drops, like a 5% drop, they might think, this is a great opportunity, buy in, but not fully understanding that actually that business has gone up 60% in the past 12 months. A 5% drop still isn't really a correction, and being patient then. So there's a lot to consider. And
And being patient while you're watching markets go higher, and that's something that happens in share markets all the time, that they can stay what is deemed by all the professionals, by all the fundamental, the metrics, the ratios, to be overvalued for years on end and become more overvalued. But the trick with a patient investor, that they're happy to wait that out, and that's what I suppose set Buffett and Charlie Munger apart completely. And I mean, you've got a couple of quotes from those two exact guys, and also another famous American investor, Peter Lynch. Do you want to take us through those?
Well, I think they're probably your most favourite quotes because you love them forever and ever. But yeah, Warren Buffett, most important quality for an investor is temperament, not intellect, and temperament really being that ability to just be really balanced, not let your emotions sway how you feel about markets or businesses at all. Yep. Just keeping that balanced mindset. Charlie Munger, the biggest money is not in the buying or the selling, but in the waiting, which is self-explanatory and really a great quote.
Yeah, for me that means two things, and yes, that one is actually my favourite quote. I'm allowed to have one, and that is the waiting when you buy, and then also the waiting of when you have purchased to allow the people that run the businesses to make their products and services better. And I just shared on our internal teams here, Dr. Carl I'm sure it's on Instagram as well as TikTok and the other platforms. He did a 2 or 3 minute video on the ASML machine that makes semiconductors. Making stuff better. This is the ultimate in incredibly complex technology that I'd highly recommend people, go and watch that to understand how complex the problems, the inventions, how complex these problems are that they have solved.
Yeah.
It's off the charts.
And why as well some of the world's biggest and best businesses are the biggest and best and don't expect to be overtaken, because that ability to generate those machines is so hard to replicate.
Yeah, and they call that a moat from an investment point of view. And there's one last quote, Amy.
Peter Lynch.
Mm-hmm.
The real key to making money in stocks is not to get scared out of them.
So again, that's not what degree you have. That is not how smart or how well connected you are or how wealthy you are. It is, how to behave at the, what I call, it's how we behave at the worst possible times that obviously will have such a huge impact on our wealth, our bottom line, our balance sheet. Cool. Thanks, Amy. What other, I suppose, talking about obviously valuations and patience, you're a relatively new advisor, 4 or 5 years in now, is it?
3.
3. What have you noticed when you've met with clients and people that it's not their job to understand share markets, it's not their job nor their interest? What have you observed in people's behaviours?
At the present moment, it definitely is how to get in, where should I be getting into, because people are just seeing that huge past performance over the short term and do want to get in on that.
Yes.
Which is completely fair enough, and that's human nature to do that.
Yeah, we're definitely not being negative the way that people behave during either the ups, where greed kicks in, or the downs when people are scared. That's
completely natural.
That's how we're built.
Yeah, absolutely. Yeah. But it is just reiterating and educating on the long-term performance and what that means for the short term. It's all about the education, as well as going into our investment philosophy even further, not looking at just the index, looking at what that's made of, whether or not someone does just want an ETF, that's the broad market, or whether they do want to go into that cherry picking and looking into sectors and business specifics and tailwinds. Yeah.
Very good. Now, people do often ask, so with markets at levels they're at, is there profit taking? And for me, the answer is no, there's not profit taking for people that don't need the cash. We're holding businesses very much for the long term. But for our clients that are in pension mode, and say they've got 3 years worth of income ahead of them, I'm topping that up a bit and are taking a bit of cream off the top, building up those cash reserves. So what I'm doing there is I'm calculating what is their net income. And a good example, let's say someone needs $80,000 per year and their net income from their portfolio is $30,000. We then have an extra 50 grand which comes out of those cash reserves. And let's say that is, we've got $500,000 in cash term deposits and more conservative assets. That is essentially gives you 10 years worth of cash reserves that you'll never be in a position to have to sell something down at an inappropriate time. And that's what we're trying to avoid.
Absolutely.
Yeah, selling at the worst possible time, when markets are down, when people are fearful, but we have to do it because we need the money to spend.
Probably the only other time I would consider taking some profit off the top is if you are only really invested into a small handful of businesses, and just to give that little bit of diversification. And hopefully, we are profit taking on quite a large amount, so things have grown a lot. You can take a little bit off the top, which hopefully is only selling a few shares if it's grown a lot, to then just diversify into other areas.
Yeah, and the businesses that we're picking on are often, the businesses that have performed the best in the portfolio, and therefore has grown substantially. And but more often than not, I'm talking about Apple and Microsoft, Meta's.
HPs for those long-term shareholders. And
there's definitely a hangover from the 90s with some of the Australian banks. They're the ones that we're picking on, particularly CommBank at the moment in terms of pricing. So that's how we're handling things, but we are long-term. That's part of Charlie Munger's quote. The waiting part of it is the waiting for the businesses to continue to improve their products and services. Yeah. Very good. I definitely did want to cover off on a blog post that I'm writing, not finished at the moment, but where I had someone ask a question on socials to say, Rob, I know you've been negative about Telstra, but the report wasn't that bad and it's gone up in value. And definitely our friend Buffett has a quote on this where, if you buy at the wrong time, even the best business in the world, and let's say that Microsoft is one of the best businesses in the world, we agree, and most people would agree with us, that if you buy at the wrong time, the best business in the world that you've just purchased can be a bad investment for you.
Yeah, if you buy over inflated values, and especially at the start, if it's the first business you purchase, that affects how you feel about share markets.
Forever.
Yeah, forever.
Yeah.
Even if you can recover from that, you just still are that cautious investor.
Correct. And at the other end of the scale, and this is where I mentioned Telstra, I've never been a fan, in 5 years of our financial planning business, investing directly into businesses that we like, I've never once purchased Telstra. And again, but if you buy it at one of its low points, which there have been many, and it goes up, it can be a good investment for you. Although that the business, we know from a service point of view as a consumer, horrendous. And obviously that's a lag because it was a government-owned institution or a government-owned piece of infrastructure.
Yeah.
So it was always going to be slow and their hands were tied early. So it's not, still, in my mind, not an ideal business. General advice, of course. And there are lots of sharp, nimble players like Aussie Broadband and Superloop. I'm not sure where did Dodo go?
Probably acquired by one of them.
But gone by the way of the Dodo. It can be a good investment, although not a good business. Yeah. But when I have doubts about products, the service levels, and I can, the long term will dictate how well that business goes as a long-term holder. And I'm very pleased that I've taken that quite a strong high conviction approach to not owning Telstra, and a very strong high conviction approach to owning Microsoft.
Yeah, absolutely.
But if people buy now at $500 and the market's correct by 20%, although it's the best business in the world, it will come down by 20% along with everything else, and that will be a bad investment for people.
That's right.
Yeah, in the short term. I have no doubt these businesses will be larger than what they are now in 5 and 10 years' time.
Telstra excluded, potentially.
Potentially, but there can be a lot of shenanigans in between, and this is the volatility of share markets, and that's why I know I go on about it a bit too much, but the psychology of share markets, because it's liquid, we can trade in and out constantly on a daily basis, just has a massive impact because we now have irrational investors, their fear and greed baked in daily.
And I think if you don't like what we're saying and you think you can buy and sell really short term, then that's trading, and we are investors for long term capital growth. Yes. So traders will probably buy and sell Telstra all the time because it does go up and down so often. Yeah, completely separate thing.
Trader loves short-term volatility for them, but I think it's that that's very close to gambling because no one knows what's going to happen in the future.
Yeah.
But the long term, I know what happens in businesses. People try to make things better, better products, better services over a long period of time. Yeah.
So, just a quick one, Rob.
Yeah.
Why hasn't Telstra been able to grow over the long term?
They have not reinvested much. At times, they've used debt to pay out the dividends. I notice now the payout ratio is over 100%, which means for every dollar that they're making, they're paying over $1 in dividend, which means no reinvestment is happening. I know early years, now I'm going back 2 decades here, that the government was really dictating to them what they could charge their clients.
Yeah.
So they had no control. Their hands were tied behind their back. So were the people allowed, the people running it allowed to do what they needed to do to make the profit stronger? And the answer is no. I also think that everyone chases high dividends and fully franked dividends for that matter, which is quite handy from a tax point of view, particularly in a super fund where it's often a nil tax environment. But I think that encourages Australian companies to pay out high dividends.
Absolutely.
In the US, they don't have that same, I suppose, method, and therefore some of those businesses don't pay any dividends at all because it's more tax advantage to keep it. That's why Warren Buffett and Berkshire Hathaway have paid no dividends for 50 plus years. It's more tax effective for them to keep and retain and reinvest, buy and build.
Yep. And we wonder why the US is the most scalable country in the world and Australia isn't.
Yeah,
Different rules and laws and...
That's right. We are very good at digging rocks out of the ground. Do we add much value to those rocks? We know the answer to that, but that's probably a whole another podcast story. But thank you for your question.
You're so welcome.
Yeah, excellent. Well, we've got a 3 o'clock appointment. It is Friday afternoon. And thank you very much for joining us. Amy, you have got new socials in terms of a new name. The Wealth Diaries is with the Dodos. Yep. So how can people find the new name now? It's Amy Lehmann.
F-A.
Okay. How's Lehmann spelled? Is there 2 ways of skinning that cat?
Lehmann. But yeah, just search Amy Lehmann. I'm sure I'll pop up, and I would have under the Wealth Diaries anyway. But
Fantastic.
Yeah, TikTok, Instagram, Facebook now.
Great.
Everywhere.
Fantastic. Thank you, Amy. Thank you for joining us. If anyone does have a topic you'd love for us to cover, please let us know. We would love to do that for you and appreciate your time.
Thanks, everybody.
Thank you, Amy, and thanks, everyone. Bye-bye.